Over the last 12 months, Nvidia is up nearly 200%, and if we just look at the last 5 years, it is up over 3,000%. And in today's episode, we are focusing on 4 stocks that could potentially 10x and outperform Nvidia in the future. We're going to look at each one of these historical performance. We're also going to talk about some of their metrics, their free cash flow, their growth in their sales, their ROICs, and for each one, not only are we going to run it through the valuation model, getting to both our intrinsic value as well as our acceptable buy, we're also going to run you through the DCF model for each one, understand where our price targets are coming from, giving a low, medium, and high rate, so you can also understand and see what price you would attribute each one of these growth companies for. First one we're looking at is HIMS, and as we can see, a double buy rating, Seeking Alpha and Wall Street. It is trading right there as well in the upper end of the 52-week range, and each one we are looking at today does have a fairly small market cap. HIMS and Hers Health around 5 billion. You can also see it is up tremendously just over the last 12 months, and when we move on to the metrics, the free cash flows, it's nice to know it has come out of the period, in fact from 2018 to 2022 where it was negative, into a positive in 23, and that upward trend is anticipated to continue over the next 12 months. We also see the sales growth looking very strong, although we do know a slowdown from the triple-digit growth in 2019. 65% in 23, still very, very nice to note. 56% on a trailing 12-month basis, again showing that the growth is still continuing. And over the last few years, we can see some tremendous increase to their top-line revenue. Now, we can also point out that while we do like companies doing share buybacks, over the last few years, they would have diluted your position as the shares outstanding has gone from 67 to 209 million. In terms of the ROIC, one thing that we do want to point out, we love companies that have a minimum of 10% year on year, just so that we have faith management are able to effectively allocate their capital. What this shows us, they do in fact have a net loss, given this is a negative 7%. The positive to note here, it has been improving over the last few years on a trailing 12-month basis at negative 1%. Hopefully we can see this positive in 2024. The same to be said on the operating margin as well, negative 13 in 22, negative 3 in 23, negative 1 over the last 12 months. So again, hopefully in the full year 24, we can see this as an operating profit. In terms of the free cash flow margin, well, as we saw earlier, looking good, 5% in 2023, and that is the bare minimum that we do want to see in companies that we do consider to invest in. Net debt to EBITDA, so that is the earnings before the interest, tax, depreciation, amortization. As always, this does essentially show us the company's balance sheet strength. 0 in 2023, indicating it wouldn't even take the company one day to pay off all of their debt net of cash on hand. The same to be anticipated over the next 12 months. So HIMS does have a fairly strong balance sheet. Now, jumping into the valuation model, let's get straight into it. Now, the DCF model is the one we are using. We have the free cash flow year on year, and we're going for 3 different growth rates, a low, medium, and high. We're going to start off with a growth of 20% as the low. We can see the average around 93%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see an overvaluation signal. Therefore, if you do see this as the growth rate over the next 12 months and beyond, we can in fact see implied downside of 18%. Now, if you believe that is too conservative, at 25%, that would give an intrinsic value of $25, and that would here, as we can see, give implied upside of 13%. Again, for those that believe 30% should be the more accurate target, that would give you essentially a high rate of 30%, with a value around $34 and implied upside of 55%. Now, as always, these numbers will be subjective depending on what you do see going forwards. Again, a lot of people may say that might even be too high, and at 10%, for example, you can see it would be valued much lower. As always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, or whether if you want to do this for your own companies as well. Moving forwards then, we will use the medium rate of 25% to get to our intrinsic value, which, as we said today, we are just using the DCF model, which comes to just under $25. Now, as always, we will use a margin of safety, which is what we typically start off with at 10%, and we execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that is enough for HIMS, then it is a buy around $22.38. We typically keep going till it's near the current trading price, but we can see it isn't at a 15% MOS just yet. It is sitting at 10%. In terms of Wall Street and their forecast, well, they do see no upside over the next 12 months. The current price is pretty much where they see this trading in a year's time. As always though, let us know your thoughts as we do go along these stocks today. Before we do move on to the next one, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on that pinned comment below where you can read these instant access as well. If you want to see all the resources and websites we use to find undervalued high quality companies, or if you want to see one of our latest articles on 12 undervalued stocks, again, all the detail is in there and it's free and instant access. The next one we have is DraftKings, and as we can see, a triple buy rating across the board, trading towards the upper end of the 52-week range. Market cap does sit around 20 billion, and over the last year, this is up around 68%. In terms of their metrics, well, it has had negative free cash flow over the last few years. Nice to note, for the first time anticipated, $1.12 of positive free cash flow per share. In terms of sales growth, well, very strong minimum double-digit growth, 64% in the last full year as well. This is still a very strong company that is growing their top line at a very rapid rate, as we can clearly see here from the numerical numbers as well. In terms of shares outstanding though, we will have to point out they have diluted your position as a shareholder over the longer term, and similar to the previous company HIMS, the ROIC is negative, something we ideally want to see turn positive as soon as possible. In terms of operating margin, again, negative across the board. In fact, negative 21% in 23, negative 13 on a trailing 12-month basis. This is one that we will keep a close eye on. Hopefully, when it does start to turn positive as well, we will see that reflected in the numbers. Free cash flow margin, well, as we said, it has been negative over the last few years. Ideally, like we can see over the next 12 months from above, this should be positive and great news for shareholders. The net debt to EBITDA, as we can see, 0.24 anticipated over the next 12 months, showing that their balance sheet does look very strong as well. Again, very similar to HIMS. In terms of the intrinsic value then, what we are looking at with a 20% growth rate for this company is an intrinsic value of $60, so already showing some upside of 44% if you do believe that to be accurate, as we can see the average sitting around 67%. If you believe that no, 25% should be used, a more accurate representation, well, it would be upside of 94%, an intrinsic value of $81. But again, for those being a lot more optimistic at 30%, we can see the implied upside here is well over 100%, $109 to be exact. For consistency though, we will use that median rate of 25%, and as we can see, $81 pretty much double the current market price. And when we do run that through, that will indicate a very high margin of safety. So when we take a look then, a 10% MOS level indicating a buy at $73. Then we keep going, so we can say what rate we are looking at right now. And in fact, it is sitting around a 45% MOS. At 50, you would have to wait just a little while if it comes down to the 40 to 41 region. So at a 45% margin of safety, Wall Street are currently forecasting around 29% upside. Their price target, $54, indicating this one as a buy and a definite consideration for the portfolio. We then move on to Enphase Energy with a buy rating from Wall Street. This one is trading towards its 52-week lows with a market cap of around $14.5 billion and is down around 37% just over the last 12 months. In terms of their metrics, well, this one has been positive for longer. As we can see, it has been increasing over the longer term, and whilst it has dropped from 22 to 23, it is also expected to continue to drop over the next 12 months, although fairly marginally. In terms of sales growth, well, double-digit increases for the majority of the last 10 years, but we can see in the more recent year going from 69% in 22 to negative 2% in 23. Nonetheless, numerically, they have seen some massive growth from 2014's $340 million to $2.29 billion in 2023, and a similar trend with these other companies we are reviewing today. They have diluted your position as a shareholder over the longer term. ROIC, nice to note that over the last few years, we are seeing some very strong numbers above that minimum 10% that we want to see. 20% in the more recent year, making it an attractive consideration for potential investors. On top of that, the operating margin is around that 16% we want to see as a minimum, 20% in 2023, and we do love to see that free cash flow margin, especially over the last 5 years, where we are seeing around the mid-20s to the low 30. Net debt to EBITDA, again, very strong trend with these companies, sitting at 0 in 23, 0 over the next 12 months, not even 1 day for them to pay all of that off, so a very strong balance sheet. So as always though, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And with a 10% forward-looking growth rate, we can see upside of 10%. For those that do believe 15% should be more reflective, we can see this would indicate 48% upside. And for those who do want to go for the higher rate of 20%, as we can see here, 100% effectively doubling the current market price. So let's take through the 15%, which would indicate 48% upside. And what we can see in today's episode is also a very nice margin of safety for ENPH. As we go at 10%, that would indicate a buy at $143. Again, we keep going till it's near the current trading price. Not a 35% MOS just yet, but pretty much around that 30 to 35% level. On top of that, we do see Wall Street indicating some nice upside, 28% with a price target of $137. We then move on to Toast Incorporate with a triple buy rating, one that is trading towards its 52-week highs, and again a fairly small market cap, 14.18 billion, and up around 20% just over the last 12 months. In terms of the metrics, well, again, it has gone from negative to positive in 2023. Nice to note that upward trend expected to continue over the next 12 months. And similar to these other companies, very fast growth, although we do see it slowing down from the highs of 2021. In terms of numericals, though, it has shown some very large growth, 670 million in 2019 to 3.87 billion in 23. And again, 4 for 4 in today's episode. Each one has diluted your position as a shareholder over the last few years. On top of that, Toast, we can see a negative ROIC, negative 23% in 2023. Margins, well, do reflect that it is essentially a company that is yet to turn an operating profit, negative 7% in 23, negative 5 on a trailing 12-month basis. Nice to note, as we just mentioned, the free cash flow margin is looking positive. Hopefully that upward trend can continue. Net debt to EBITDA again this year as well as expected over the next 12 months. Not even one day for them to pay off all of their debt. A very strong 10% growth rate, as we can see, would indicate an intrinsic value of $31, giving upside of 20%. At 15%, well, this would indicate upside of 60%. And for those, again, who want to be optimistic at 20%, we can in fact see that this company would be more than a double, 114% to be exact, with an intrinsic value of $55. As always, that median rate of 15%. Don't forget as well, if you do want to run your own numbers through, you can grab a copy by clicking on the pinned comment below. The intrinsic value then at $40.83, with the current price at $25.54. Another company with some nice margin of safety. At 20%, you'd have to be buying it around $33. At 30%, around $28.58. And in today's episode, it is pretty much trading near a 35% margin of safety, not quite at that 40% level just yet. In terms of Wall Street and their expected upside, well, they only see 10% with this company, although we did have that triple buy rating earlier. $28 is their target. And as always, do let us know your thoughts in the comments below, whether or not you are adding to any of these. And as always, if you did take value from this, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.